And I remember sitting around the table thinking, are we really going to do this? Are we really going to do this? And we're like, yeah, we're going for it. We wanted to spin out, and we needed to spin out. And so we did. And we took our 11 employees in our $2 billion of AUM.
All right, we are here in Helsinki, Finland, and I'm so excited to be joined by another special guest, Lisa Edgar, partner emeritus at Top Tier Capital Partners, one of the trailblazers in our industry.
This episode is brought to you by Helsinki Partners. If you are an international fund LP or growth company looking to expand to Europe, Helsinki Partners provides you free of charge services sponsored by the city of Helsinki. Visit or find your new career in Finland's capital, Helsinki. They are your go-to.
Hat tip to my friend Jan Amri for putting the Finnish ecosystem together and really building all these opportunities for us to connect. Now let's get started. Lisa, I am so excited to see you.
Thank you, Sarah. It's great to be here.
You've seen it all in many ways, through the cycles and all of the above.
Yeah.
What do you think of the current market environment?
You know, no matter where you go in the world, and if you're engaged in the venture community, I think everybody's feeling the same things right now. It's a more difficult market. There's a lot of questions about valuations and where things are going to land, and making sure that deals get done, and etc. But I think this is a really vibrant community. There's a lot of technology here. There's a lot of research and development here. There's a lot of government sponsorship here, which you could say about a number of cities in Europe as well. Therefore, it makes a nice, robust community, and there's an active seed, first check seed, community here. But then there's pan-European, these companies get started, they go more global, and so there's investors now here that will invest throughout Europe.
What was unexpected that you found out on this trip, I guess, in terms of Finland and the environment or the ecosystem in Europe?
Yeah, I think it really is how big and active it is, really. The conference was bigger than I expected. And when I walked in the space, I thought, oh, okay.
When you actually go there, right? The pipeline question. Even for women, people say, oh, there are no women.
One of the things I have to admit that was unexpected, specifically at Arctic 15, is there was a large contingent of people here from Southeast Asia, specifically Singapore. And we know there's a lot more family offices there than there had been in the past. And I think there might have been a relationship between the city of Helsinki bringing some of the people here, but that was surprising to me.
Yeah, was a great interest area for portfolio diversification and all that. A lot more to dive into, and we'll do that a little bit more and continue on that trends of what we're seeing, family offices, so forth. But to first get started in billion-dollar moves fashion, who is Lisa? And I hear that you started in hospitality, but then became this trailblazer in investment. How did that happen?
Yeah, it's a very kind of serendipitous, curvy path to getting here and being here in this room with you and being at the conference, and a long-time investor in venture capital funds. But when I was younger, I didn't have I want to be a doctor, I want to be something, and I love to travel. I love people. Learning about the hospitality industry, I thought, this is perfect for me. This is what I want to do. So I actually went to a community college in Pittsburgh, Pennsylvania, and got an associate degree in that. And I did work in the hospitality business for 4 or 5 years, and I loved it, but I knew it wasn't what I wanted to do forever.
Why is that?
I think it was a lot of kind of physical and emotional resource that I had to have, but not as much intellectual stimulation. And so it just wasn't everything that I wanted to do, for the future.
And how did this opportunity then arrive for you to swiftly make the move into investment?
Yeah, it was not swift. Nothing is swift. Yeah, I also had a very strong interest when I was growing up in investments, specifically the public stock market, right? Because the private markets weren't certainly nearly as big or big at all or as active. So I really loved the public markets and just had an interest in it in a way that I would get like a Business Week subscription when I was just a teenager. It was very strange when I look back. I didn't know what I was doing. I wasn't doing it on purpose. My family wasn't in that business, but it was something that I was interested in. And so when I wanted to leave the hospitality industry, I was in San Francisco, and at that time there were some very small boutique investment banks that were actually taking the technology companies public. Montgomery Securities, Robertson Stevens, Hambrecht and Quist, and I wanted to work for one of them. I wanted to be in the stock market, and I wanted to be with one of those local boutique banks. Now, that's not what happened in my career. I ended up getting a job at the Federal Reserve Bank of San Francisco, but it kept me interested in finance and in the broader world of investment. So I did eventually get there, but I didn't get there through the path that I originally expected.
How did you then, ultimately get to, I guess, Horsley Bridge felt like you were coming into a career, right?
Yes. When I was at the Federal Reserve Bank, we were building a database of bank holding company structures. Mm-hmm. I ended up being with a group that was writing SQL code. I mean, you can't make this up.
Yeah.
And that particular skill set was something that Horsley Bridge was looking for, because even way back at the beginning, they were very keen on having data and using data to help investment decisions. Now, of course, all we talk about is data. Everybody uses it. We buy it. We, use artificial intelligence on top of it, machine learning. But they were kind of unique in that. And because I had this strange database skill set, I was able to get a job there, and then I kind of grew my career from then. So I was really working with the data, and then I moved to be an analyst, and then the rest is history.
And what are the top 3 learnings or mistakes?
So one of them I remember, Phil Horsley saying is you have to have patience. And it's so hard to have patience when you're young and you want to just grow and you want to move up and you want things to happen. But in these private markets and in these startup companies, it really does take time. So that was really important to learn. Way back then, we learned really about relationships, right? And how it really is a relationship business, how important those are. And really the way you treat others and act in the markets is going to really kind of stick with who you are, how people want to work with you. So those are kind of related. That's kind of number 2. And then I think the third one is you got to do the work. You really have to do the work to make good investments. And there's startup companies or early funds where you're looking at past performance and you're making a leap of faith into what markets might get started in the future and where the world might go. But those are the things that you really need to do and be able to do to be a good investor.
As an analyst, starting your career, and now you hire them and you see them around there building their careers, has much changed in how the world of analyzing funds and thinking about it, has it changed much?
I think so, because there's a lot more information and data out there, but there's a lot more ability to be engaged in the market and not sit in your office. And there was a lot of sitting in the office, answering the phone, getting deal flow that way. But now everybody's out. You're out meeting people. You're meeting entrepreneurs. There's all of these kind of accelerators and startup communities and such. So it feels like a totally different business or different way to approach the business than it did early days. I mean, this is the thing that a lot of people that were hired were ex-investment bankers or ex-consultants. That's really not the case anymore. And you want people that have worked at startups, that maybe had started their own companies, that just have been more hands-on, even from the early days.
And why do you think that's important in terms of a skill set? I guess the question that was asked to you was hard skill sets and soft skill sets that makes GP successful. Do you think there's some element of that?
I do, because you have to understand and have some empathy for what it's like to be a startup. It's not like analyzing a business in a buyout shop, right? Where you have EBITDA, you have numbers, you have customers. I mean, here, there's so many pivots that take place. The world is so much more global than it ever was before. So you need a lot more diversity in who is part of the team and the skill sets and the backgrounds, etc. So the world looks different too, which is actually a good thing.
Yeah. And what were some of your highlight deals in your time at Horsley? I mean, I'm sure there are big names that we now hear of that you were part of as an analyst back in the day.
I think when some of the firms got started, or when they really started being the top firms like a Kleiner Perkins, to be involved in those firms. But I will tell you, some of the top firms that we invested in that would have been considered access plays back in those Horsley Bridge days, there's many of them that don't even exist anymore, right? So they have not been able to make that transition to the next generation and to just new times in the market. But there was also a number, like a Benchmark, right, that is still one of the best firms and has made it through multi-generations and multi-cycles, etc., and has been able to continue to be a top investor and a top firm for venture.
And I want to talk about that a little bit before we shift to top tier in building an enduring franchise, which you're arguably doing right now. With some of these firms that don't exist anymore, as you said, was that surprising to you? Were there some key factors that stood out in those who actually did it successfully and not? Like what makes an enduring franchise?
You have to set a goal of building a franchise, right? So that means this firm, this entity is going to last beyond the people that are in the room today, right? So you really have to, and some people decide that's not what they want to do, and that's not the way they're going to build the firm. Investors, institutional investors, generally are looking for a firm that has some continuity that they can stay with, right? So that is, and there's exceptions to all rules, but that's generally what institutions are looking for. So you think, well, how do I do that? How do I build a brand, which is important? I have a name that people know what I stand for and how I operate in the environment, how I treat people, how I do deals, etc. And then how do I hire people, bring people into a partnership, and as people leave a partnership, and let's start, good leavers, people that retire, how do they leave the partnership, and how do you make that smooth? How do you make that transparent? And often the ones that have not made it have not done that or done it well at all. That's the majority of why these firms don't make it. But also, sometimes the markets change so fundamentally. I want to do telecom equipment. This new thing comes along, internet. We're not doing any of that. Well, telecom equipment falls apart. All that money during kind of the dot-com bust goes away, and you have nobody on your team or any investments that look promising in the new internet world. And so your LPs go away. And you can't keep your team together, etc. So sometimes it's markets, but most of the time it's a people.
Interestingly, Sequoia, Benchmark have done a pretty good job.
Yeah.
What stands out to you in these firms and how they did it?
Sequoia is probably a little bit less clear, at least to me, how they did it. Benchmark did it by equal partnership, bringing people on, people knowing when they're ready to step off. I mean, there were certain things about the way they organized, the way that deals got done, that they actually shared with the broader community. And there were people that would use that as, we're an equal partnership like Benchmark, or we're setting ourselves up like that, because they looked at what they did. And I'm not saying that the way they organized is what drove all of their success. It laid the groundwork and made it easy for the right people to come in, for them to get the right people to come in, because they were very talented investors, right? I mean, you would never not give them that credit, but it just makes it so much easier when it's kind of known and it feels equal and everybody feels trusted and respected, and the economics are shared the way you feel is
so thinking
equal.
Basically in terms of the carry split and how that's distributed across the firm.
Right.
Interesting.
Yeah.
So unlike, in some firms, and we see that today, unlike some firms where it feels very, this is my deal, proprietary, Benchmark essentially, were they one of the first few pioneers who said everybody gets a slice of the pie in some way?
I don't think they were the first, but they were vocal. It was very clear when they set up, this is the way we're going to set up, and it hasn't changed.
This then inspired you, as you continued to work with firms and enjoyed it, inspired to go out on your own after 10 years. Tell us a little bit about that decision making, why and how.
Yeah. What really happened is that when I left Horsley Bridge, I spent a small couple years at W.R. Hambrecht. So remember I mentioned Hambrecht and Quist there. This was Bill Hambrecht's reincarnation of a boutique bank. And then I went to work for Paul Capital. Top Tier spun out of Paul Capital. And we spun out of there. We were the venture capital fund of funds inside a broader organization that did secondaries, healthcare royalties, and a venture fund of funds. There came a time, for various reasons, that we wanted to spin out, and we needed to spin out. And so we did. And we took our 11 employees in our $2 billion of AUM and walked down the street in San Francisco. And as my partner, David York, said, we repotted ourselves in the Transamerica Pyramid in San Francisco. We rebranded with a new name. We had new investors, and that was the beginning of Top Tier.
Yeah. And tell us a little bit, framing for the audience here, many who are LPs and GPs, but maybe have not lived the cycles that you have.
Yeah.
Where was Paul Capital in the construct of things? $2 billion AUM, that was a lot to start with, arguably.
Yeah, it was a lot, but they had secondary funds and pretty large secondary funds. So the firm had more than $2 billion of AUM under management. So we were like a small piece of a broader platform. But it is true, and that's why I say this, because I consider myself a co-founder. I was one of the original partners. I wrote a check into the organization in order to get it started, but we were lucky. There were 11 of us, and we had some AUM under management, which meant we had investors already. Now, keeping those investors as you spin out and as you change your kind of LLC is tricky, right? And setting up that LLC correctly is also tricky. Getting the right investors, getting the right terms of that investment, having the kind of founders and the partners own enough of that organization that they are incentivized to move forward with it, and consider it that they're a founder, right?
Yeah.
And they want to grow this thing and have a lasting organization for the future. And the partners that spun out, we really had that vision. We wanted to do that. And I want to talk about the name for a second, because in so many ways, it's just brilliant.
Yeah.
Because now when anybody says Top Tier, they're talking about Top Tier as far as a top quartile or a top performer.
It's great branding.
It was brilliant branding. And I remember sitting around the table thinking, are we really going to do this? Are we really going to do this? And we're like, yeah, we're going for it. And it's a name that we have to live up to, right?
Absolutely.
We are Top Tier, right? Which means not only the performance, which is, foremost, but it's also who we are, how we act, the reputation we're building, the people we're hiring, etc. So it was big and bold, and I love that we were big and bold at the beginning.
Techish, hosted by Abidesi Usansadi and Michael Burhane, is brought to you by the HubSpot Podcast Network, the audio destination for business professionals. Techish is a podcast by two amazing millennials talking about all things tech, pop culture, and life, and it's a ton of fun while being power-packed with information. I enjoyed their recent episode that covered the attention economy, and yes, Tupac's murder. From why the attention economy is stronger than ever, to Shopify CEO saying no side hustles, to unpacking how Tupac's murder was finally solved. Years later, the range these two cover is something else. Tune in to Techish wherever you get your podcasts.
I guess I learned from folks like you, but unintentionally, we started the $1 billion fund for women.
I know, same thing.
And when you have billion and women, eyes raised, but you have to live up to it, right?
Yes.
You have to go beyond the billion, which is what we're doing right now.
That's right.
So fascinating. Yeah. So new chapter, repotting yourselves.
Yeah.
how did you then go on to build a firm? How did you think about it? What was the strategy? Did the thesis change over the years? Tell us a little bit about this chapter.
It's not easy. And there were a lot of ups and downs. There was a lot of commitment. I tell people it's a 24/7 business. You really just have to have the passion about what you're doing. When we left Paul Capital, we had a relationship with the Bank of Ireland, and there was someone that was working with the Bank of Ireland that was a behavioral psychologist, and they were like, you should use this person, him, and help you as you think about starting your organization. And it was from, what's your mission statement, what are your goals, like some of that basic stuff. But we did it from the beginning, and we had this kind of mantra at Top Tier. It was, we called it LETTR, LTTR,
right.
Leadership, Trust, Transparency, and Respect. And we tried to really embrace that and ingrain it inside the culture in a way that all the team understood what that meant and what it looked like. And so like every quarter we'd pick one of them, and then we'd have the culture committee. We literally had a culture committee. And this was before like the Me Too movement, when now it was like, okay, everybody better really think about their culture.
Exactly.
We had a culture committee, and you'd give awards like for who was the best leader for this quarter. And so it was like, what does that mean? Well, this is what it means. So we'd show videos or have some discussion about what a good leader looks like. And it was just something that I think brought us together outside of, this is the way we do our diligence, and this is the way we operate, and this is the way, we invest, to this is the way we're building the firm. And I'm still such a big proponent of thinking about all of those things from the beginning.
And tell us a little bit, spinning off a new entity, were you able to bring sort of your track records with you?
Yes.
Were you able to lean on Paul Capital in some way to be able to have this start a little bit easier?
Yeah. We still used some of the back office, in the early days when we spun out, but we were able to take all of our clients, all of our current LPs, all of our current employees, and the track record. So that was much easier than people who can't do that and really start from the beginning. Because, people always want to see what's your body of work. And, I work with a lot of emerging managers trying to say, okay, what have you done, and what is the investment, and how do you package that and present that in such a way that shows the quality of your work? And you have to get creative about that. But yes, we were lucky in that we had that.
When you're thinking about building infrastructure, and for the LPs that are running fund of funds, what were some of your mistakes in the early days in how you built the firm? Was there anything that you would have done differently?
I think recognizing back office and, do you outsource? Do you do it in-house? How do you work with your providers if you're going to do it that way? So that was a big question, how we were going to do that, and whether it was going to be robust enough to satisfy what we were trying to do. I also think that setting, I keep going back to setting up the ownership and the structure correctly from the beginning is something that can really trip people up as well. Hiring is always one of the important things. Like, are you hiring for a particular position, or are you hiring someone because you just think they have great skill sets, etc.? So I think we had some missteps on hiring. I think everybody does that until you really get it right. But those were some of the main learning. And then the notion, even in a fund of funds, it's always be selling, always be closing. We were always fundraising. Yeah. And that was important to really kind of understand that the capital drove the ability to make the investments. Then you had to have the performance. Then you had the capital again. And understanding that, but not necessarily having the fundraising drive or overpower the importance of the investments. You know what I'm saying,
Yeah,
right? Because
absolutely.
the capital is absolutely, key, number one, but you can't take your eyes off the ball as
Yeah.
far as the investing.
So keeping your eyes on the ball, what was the investment thesis on how you would achieve top-tier performance?
We always were a bit of an access focused, name brand focused venture fund of funds, and Top Tier still is today. Therefore, there's a core portfolio of kind of top performing, hard to access. Then you're always building your farm team, because what you learned, I said this before, is not everyone makes it through every cycle. People lose their way. Sometimes they get too big. I mean, there's various reasons why you don't necessarily re-up forever with all of your fund managers. So you always have to have a group of managers that are coming up in the field.
Going deep into the investment side of things.
Yeah.
What was your strategy? How do you think about portfolio diversification? Did you start at the get-go with the strategy that we see today, or has that evolved over time?
It has evolved, and it continues to evolve with the markets, and
Yeah.
as things change. I mean, we're not timing the markets, but how much international, are we in Europe or not,
Yeah.
etc. That has changed over time. We always did tech. We always did healthcare. There were some fund of funds that didn't invest in healthcare funds or biotech funds, but we always did. We had a focus on early stage venture, where the managers own a lot of the companies, and that continued. But we also wanted to always have the emerging managers and maybe some late stage managers. And then because of our roots at Paul Capital, we really knew the secondary business. We added secondaries to the funds, especially after the global financial crisis, to help smooth the cash flows. And what was happening after the global financial crisis is a lot of investors just were really seeking the ability to always have some liquidity, because they couldn't invest and go through this long J curve. Yeah. They wanted to see some early liquidity. So we created portfolios with secondaries and co-investments that created early liquidity for investors so that they could get some DPI and get some cash back. And then the early stage fund investments would really deliver in the future of the fund life, of the fund of funds life.
Did you have a vision of the specific technology that these funds were investing into? Were you making a bet? Did you have a specific vision, the thesis question that you asked your managers?
Yes.
Did you have that thesis at the granular level?
Not really. Only because it ends up that the best managers kind of look, that's what they do, that's what venture capitalists do. They look into the future. They go where the puck is going, as we say, the old hockey, terminology. So we thought by investing in the best, we would get into these markets. And that was true. Whether that be Web3, whether that be B2B software, all of this AI, people move where they see the world going, especially the big, well-established, very successful players. Now, does that mean around the edges we might have said we want maybe more of this or less than this? Absolutely, we had done that. But sometimes we don't want more of it. We're going to take what the market's given us, but we're not going to double down into, something like clean tech, for example. In the first iteration, we didn't double down on that. It ended up being a smart move, but there were certain areas like that we did. And then internationally as well, we started investing in China and in Asia in 2006, 2008 timeframe. There were a lot of US LPs that started investing in those global markets. They looked like they could have provided some more multiple than what we were seeing in the US, and that was true for a period of time. So it was a smart kind of move for a lot of LPs. So around the edges, and every time we raise a new fund, we have that discussion. What do we want this to look like? What is our portfolio construction? Do we want to make sure we have enough, now climate tech funds, and there's kind of movement around the portfolio allocation to do that for sure.
So two questions I want to ask from that. One is portfolio construction. This is ultimately what makes or break any investment entity, right? Do you think about re-ups? Did you have a set criteria of, okay, if this checks out a whole list, we will re-up? How do you think about all of that to really drive alpha here?
Some of it was quantitative, some of it was qualitative. So one of the things we did, if you think of a fund of funds, it's a discrete portfolio. What we did was actually take the performance, so we're talking about net IRR, TVPI, DPI, so that's total value to paid in, distributed value to paid in, and we would sort rank all the funds that were in that particular discrete portfolio. So you could see who's in the fourth quartile and who's in the third quartile and so. And we'd watch that move. We watch these managers move over time. I mean, sometimes you do go into a big J curve because you're an early stage manager, you're doing seed, you're calling management fee. And we understood that, right? We were sophisticated investors and understood early days, you can't really look at these quartiles and make any decisions that you're going to re-up or not re-up. Then there was the qualitative piece on top of that, right? Is the team stuck together? Are they doing what they said they're going to do? Do they have good deal flow? Are we hearing good things about them? Are they co-investing with the best people? Like all the things that we could ascertain from the market and for being out in the networks and having conversations, etc. So we would combine those two things to determine, what we were going to re-up and who we were going to re-up with and who we weren't. One of the things, though, that happened over time, as we got to be a larger organization with a larger team, we had a lot more inputs of people that I'm working with these managers, you're working with these. I like my people because they're doing this. So there was a lot more discussion around those Monday investment team meetings as we were really trying to do deep and thorough and thoughtful analysis on who we thought could perform in the next several years as we were, making those re-up decisions.
And how do you decide there? I mean, there's a lot of ego in play. There's also a lot of unknowns, right? For a long period of time. I mean, the challenge with fund of funds, it's 10+2 type structures where you're really in the long-term patience game, as you say. How do you, think about shifting strategy or, thinking about portfolio construction when there's so much uncertainty there?
Yeah, I think, which is the reason why fund of funds and those that have been in the business for a long time are really great investment vehicles for people that either want help with their venture allocation, want to start with a fund of funds as venture allocation to learn, because after so many decades and the pattern recognition, you could start understanding and knowing the questions to ask, knowing certain red flags that you might see inside organizations. So, for example, there was a fund that we invested in, and they started with a small portfolio that they brought in. It was one of the emerging managers. They brought in a small portfolio, and most managers, new managers, they get going right away, right? Because they have a lot of deal flow. They've been talking to people, and once they get the capital, they're moving. This particular fund, nothing was happening. It was like, something's wrong. And that red flag goes up. We call it, we often call it the spidey sense, It's like something's going on. And that's what I mean,
So when you look at your, I guess, best performers, and maybe we won't name names here, but the lesser quartile, right? The lower quartile, what stands out? I mean, you've been doing this for 20 years. So what is the criteria, and how can managers actually build for success here?
There's no silver bullet. There's no secret sauce. I mean, other than, be a good investor. I mean, how do you become a good investor in startup companies? I mean, after a while, people have it or they don't. And So
you don't think it can be learned? You either have it or you don't?
I think it's a mentoring business on how to look for things and maybe how to be a good board member and such. But I think some of it is kind of innate, and I see that in people. You just get some people who get it, and we use this term good stock picker, and then some people aren't. And I think, like VCs will say this about portfolio companies, they don't change the management early enough. And I think sometimes when somebody's really not making it and it doesn't look like their companies are really going to be the outliers, it's hard. It's a hard thing to kind of cut ties with, but it has to happen sometimes, right? I mean, not everybody's cut out for this business.
One of the questions that fund of funds get asked a lot, as I'm sure you have, is it worth the double layer of fees? It's the 110 and then the 220, and in the end you're paying a lot, and arguably 20 years later the market has become a little bit more open, where family offices are doing it direct. Does the business model still work?
So not all fund of funds are 1 in 10.
Yeah.
That's one thing. As I said, there is a place in the market for fund of funds for sure. I'm surprised today how many new fund of funds are getting started, because it's not an easy business in some ways because of this question.
Yeah.
People don't like the fee on fee, and I understand that. In the end, if you're delivering the returns that the investor needs for this part of their portfolio, which we were, even as a fund of funds at top tier, then it is worth it, and it is worth using that type of construct. Often people start with the fund of funds to learn, to start building the portfolio as well, and then they might make their own individual bets, into funds directly. So I do think there's still a place for it. There's also maybe certain geographies that are hard to access, maybe a fund of funds that's going to focus on climate, or a fund of funds that's going to focus on building a portfolio of women-led VCs. So there are areas of the market more niche focused. Maybe they're going to do small micro funds, right? That's hard, because if you're a large investor but you want some micro funds in your portfolio, you're not going to make investments in little $25 million fund. I mean, it's just not worth it to you, but you might want to use a fund of funds for that. So I think there are places for it. There's also some large investors that they need to make $100 million commitment. So it's better for them to outsource their venture allocation to a fund of funds manager.
Yeah.
And then do their direct investing in maybe large buyouts and infrastructure and other things like that themselves with their own team.
So I'm curious, I mean, you mentioned a trend there where it becomes a starter play, right? For many, typically family offices or even large pensions foundations who want to get to know venture, for example, venture capital, and use fund of funds. But eventually they know enough from you. Are you sort of cannibalizing your own LPs in some way? And how did you handle that? I'm sure that happened to you a lot throughout the 20 years.
Yeah, it did. And actually, we were okay with it. As long as, of course, we can continue to find new LPs, which we had been. But we thought if that's what somebody's strategy was, and we were both clear up front, then that was okay. That was okay with us. Because we understand, like, if you are new into this area, this, venture investing, and you say, okay, I'm going to work with you, I'm going to watch what you're doing, I'd like to be introduced to some of these managers, every once in a while I want to come to Silicon Valley and do a road trip and meet people, etc. And my expectation is I'll make, 2 or 3 commitments into your funds, and then maybe not again. We would be okay with that, but not everyone was.
And you have to, of course, make the economics work, as they drop off and bring in new ones and all that. And did you continue to co-invest with those LP investors as well?
We called them we called each other for diligence. Yeah. The one thing about fund of funds, though, is that often there are investors out there that want to see your list because they really want to do it themselves, because they feel like they can do it themselves. often they really can't do it themselves because some of those names on that list they really are access plays and will always be access plays. But that was frustrating.
I mean, we see it today in many ways.
Absolutely.
So tell us about access plays here. I mean, that was a big part, and you've mentioned it 3 times here. I think that's a big part of Top Tier's secret sauce. Yeah. How do you get, into the best funds, and what were, I guess, your really key learnings and key mistakes in really doing this work?
Yeah. It really is relationship building and being a good partner to the GP, getting to know them, being somebody that they could trust and count on, being active in the ecosystem. That was really the way we did it. I mean, sometimes we used, like Phil Paul, who was the founder of Paul Capital, who had relationships with the founders of some of these name brand firms, so we went that way. And when you think about relationships, which is probably also a word I've used many times, we encouraged our team, especially the investment team, to build relationships in these venture organizations with their peers. So, for example, the analysts and associates should be getting to know the analysts and associates, the principals and VPs, the same thing, the partners, because, first of all, people mature, and the next thing you know, the analysts are all running the firm. They're making the decisions, right? So we also tried to build deeper relationships. So there wasn't just one person at their firm and one person at our firm, because can be a weak
link.
Link.
You have some pretty exciting names in your portfolio that have become true legends in the industry. Were there any exciting deals that you can share about, that you were in the ringer with them? Was there anything that comes to mind that was really a difficult deal that somehow it broke through and that was like a great moment for you?
When you are trying to access certain names, like we've had some partners join, right? And they had a list of names that they had relationships with. So being able to convert, person to person is always something that you're not sure is going to happen.
Yeah.
And we've seen that happen. Personally, and what's kind of near and dear to my heart is some of these, we call them alpha managers, but the newer, smaller, emerging funds, and watching some of them really become successful and then being oversubscribed themselves, even though they're still small emerging managers, but not be able to take all the capital that wants to come in those funds. And I think for me that has been the most rewarding part of, I think, my journey, and why even today I focus more on helping newer, smaller teams that I think have the ability to build something really special, especially folks that don't look like everyone else in the industry.
And what was the hardest thing that you've had to do in the 20 years of building the firm?
A change in GPs and key man tripping and things happening. They're very difficult. They're very emotional. They're very difficult. And sadly, we had to do it more than once. Yeah. It's a lot of work. It's getting LPs and consensus around that. And that's why you do so much work on the team and the team dynamics and what really is going on, and whether or not the relationship and the bond and the partnership is truly a partnership that can withstand not only the good times but also the bad times, kind of like today's market.
And that's a great segue. Let's talk a little bit about markets. How are you thinking about the shaky markets here?
It was a long time coming. Everybody knew it was coming, right? And it was a long bull market in venture capital. And now I think watching valuations, I don't think they've all settled yet. Fundraising is quite difficult. And the experienced managers that have been through this before, it doesn't mean it's easy, but it's like anything. When you've seen this show before and you understand how the structures of the deals are going to unfold and how to behave and what you need to do inside your own portfolio and how you keep your team motivated, all those things, this is where the experience is really going to matter, because we are in that market. And, I know the NASDAQ is up a bit, and NVIDIA is leading the way, of course. It's still a difficult market, and as people talk about, there are alternatives now with interest rates being not zero, that investors have options where it was hard to find any type of growth or any type of return in the in markets other than privates and some publics, but now there's fixed income and credit in different places that people are starting to spend a little bit more time with.
And what do you think needs to change in venture, and will this market be a good thing or a bad thing in changing things in venture?
One of the things about venture and the success of venture, it's been great. It's changed our worlds, made things easier, made us more connected. Really, I think gave a lot of people opportunities that they wouldn't have had, without all the venture kind of engine. But it's been done without all the guardrails that needed to probably take place. And now the discussions around AI, where I'm not frightened by AI and I'm not a doomsday person, the world's going to end because AI and nobody's going to know what's real and, all jobs are going to go away. I'm not that person, but I am hopeful, because it is a big trend and there's a lot of investing happening in that space, that there'll be a lot more thoughtfulness about the outcomes and what the repercussions of some of that. I think there needs to be more investors, globally, just opening it up and having more kind of institutional investors. Like there's a lot in the US, but there's not really a lot in Europe. For example, there's a lot of government investors, but not necessarily a lot of institutional investors. A lot more diversity in who is getting the money, whether that's the fund managers or the entrepreneurs. So I think all of those things, three things, really need to change to make it just a better place.
And you were in Silicon Valley for a long time as well. And that's where you mentioned this top of the interview, the Me Too movement happened, and venture was very much caught up in that. As an LP, how do you think about that in ensuring that GPs are being ethical in the way that they conduct themselves?
The Me Too movement gave a lot of LPs the confidence to ask the questions that they wanted to ask but didn't feel they had the power to ask, especially women LPs. And these questions were being asked. I'm in a number of women in private equity networks. I know you are too. There's some great ones. I have some of my best friends that are from there. And those questions were being asked, and we were trying to help each other, but I think it gave us the confidence and the space to do that. It was horrible what happened to women and that had been going on. In some ways, the spotlight that was shown on it was just so necessary and so important. So many groups kind of started or really kind of came in with force. Even the NVCA, the National Venture Capital Association, came in with real solutions, real workshops, real discussions, and it still exists, right? It wasn't like it's a moment in time, okay, that's over, we're moving on. So that's what, and it needs to continue, right? And what the work you're doing and the work that I help people like the Bridge that we talked about, that is so important to continue to have these organizations that are working, to change that.
Do you think LPs could be more vocal in the way they conduct themselves? What needs to change among LPs, I suppose is the question.
So there was a pass the blame, I felt moment in some of this where it was like, well, the LPs should not, it's their problem because they're not telling the GP, they're not making sure there's female GPs and they're not doing this and that. And everybody in the end has a fiduciary responsibility for returns. That's the majority of investors. That is the number one goal. Yeah. Now, these things are not mutually exclusive, right? And we all know that too. But it wasn't like you could just flip the switch, because in some ways there wasn't enough resource, there wasn't enough information, data, etc., for people to really know what was available out there, because a lot of these more diverse managers and women didn't really have a voice. Right? And so these platforms elevated their voice, and then there was a lot of investors looking to make sure they were getting exposure and investing. Some of them, had specific allocations. Some organizations were set up to only invest in more diverse managers, and otherwise, I think people just kept asking the question, so everyone felt compelled that they had to do something. And I shouldn't say everyone, because that's not fair.
Yeah.
A lot of people, and certainly what I would say, the top managers were compelled to do something.
You know it, we know it. Next year is creeping up quick. If you want to win inside your niche in 2024, you need tech that puts you in the pilot seat. Collaborate on every inch of the customer journey inside the new HubSpot Sales Hub. With a comprehensive prospecting workspace and powerful sales analytics tools, data is connected across teams so leads never slip through the cracks. HubSpot Sales Hub lets you accelerate every facet of your sales operation with precision. And with over 1,400 integrations, there are tons of ways to mix in new features. So finish out Q4 strong and gear up for the new year with HubSpot Sales Hub. Learn more at hubspot.com/sales.
Yeah. And where do LPs make mistakes in? I mean, one of the things that you brought up was there needs to be experience. Experience is so valuable at this time, but of course, women and people of color don't have traditional experience. They have a more circuitous journey.
Yeah.
They don't look like the typical pattern of success. How do you address that, and how are LPs doing in this regard? Are they making mistakes?
I think a lot of these, some internships and mentoring programs, and I'm talking formal internships and mentoring programs, can really make a dent and bring people into the organization, because you're right. I mean, there's a lot of people don't even know that the industry exists, right? And reaching out into a broader pool, whether it's colleges, universities, even going younger, into different schools, whether it's high schools, and some are even going down to the elementary school level, to just show that people like you and me are in this industry and have made full careers in this industry and are willing to be mentors.
Well, Lisa, so many more questions I could ask, and then we'll continue in drinks later, perhaps.
Yeah, perhaps.
But we'll transition now to your most recent chapter, final move to Portugal, to look into Europe, working with Tom at Open Ocean. What does this next chapter look like for you?
Yeah. So I moved to London in 2019 as Top Tier created a office there and focused more on Europe and raised a European-focused venture capital fund of funds, doing primaries, secondaries, and co-investments, very similar to what the firm had been doing all along. And I just loved it. I loved it. There are so many talented people. There were unicorns being created. There were people, thinking about entrepreneurship in a whole different way. There were educational platforms and programs and accelerators. There was global thinking. And I just thought I could be here at a time that looks like Silicon Valley did years ago and participate or add some wisdom, some little touch of wisdom to how to create a lasting organization, a lasting industry, to what are some of the pitfalls, some of the learnings, etc.
Yeah.
And that's really what I do today at Partner Emeritus, Top Tier, no day-to-day activity, strategic advisor. And you mentioned, working with Tom and Katya and Patrick at Open Ocean, they want to build a better firm. They have a firm, they have some funds, they have some great investments. Like what does world-class look like from an LP point of view? I bring the LP hat to people. I actually help, advise and a few other GPs and some investors. And it really is from that LP point of view to try to kind of up the game a little bit. Because some of the things we heard about Europe, it was, okay, lower prices, there really are companies, this and that. Yeah, but it's Europe, and they take 6-week vacations, and that kind of typical, they're not working like the Americans and such. And how do you find that happy medium between the American way and the European way and blend that together to make a very successful firm and, investment activity? And there's good parts of both cultures and there's bad parts of both cultures, right? And so thinking about how to marry them together is something I really enjoyed doing.
Very exciting, and very exciting to see, that this next chapter in beautiful Europe. And hope to see more of you. Yeah. Final section, which is the fireside questions. Very quick, first thing that comes to mind.
Okay.
Felisa Edgar. All right. Your guilty pleasure.
My guilty pleasure. It, right now, is following my daughter around Chicago into some of the coolest art galleries and music venues and such. She's an arts critic. And I just love it. She calls me up and goes, I have a ticket to this, or I'm doing this, and it's just so much fun.
A habit you've picked up that has changed your life?
Yoga. I picked it up a long time ago, and it really makes a difference.
I do it every day. I have my yoga mat with me everywhere I go.
Great.
Yes, I do.
Great.
What would you tell your younger self?
Yeah, I think it might have come out a little bit. There's a lot of serendipity in my life. It's turned out fine. I still love serendipity. I wish I would have had more of a plan, which is a weird thing because I think I tell people today, you can't plan everything.
Yeah.
You can't plan everything. But I am very much a serendipitous, opportunistic person, and I wish I would have had a little bit more focus. Yeah, which is interesting.
What makes you happy today?
Being outdoors.
Yeah. Outdoors somehow.
Hiking.
I guess I got that tip. Yeah.
That's right.
What's your biggest insecurity still?
Yeah, I think it's, am I focused on the right thing, and am I making am I making a difference? Like, some people come up to me sometime and said, I heard you say this, or you said this to me, and I think, really? That's really made a difference and changed, and that wisdom was actually helpful.
And this was a $1 billion question from a previous guest, Danielitika, who was just here. In this market, how do you win as an investor where potentially, and this is how you framed it, you are the only winner and everyone else loses because it's a crazy idea that you took a bet on or something along those lines?
I don't think this is a market where there's one winner ever. There's certain markets where the winner's the biggest, but there's probably not a lot of markets where the winner takes all. But I think it's not necessarily getting in there early. It's getting in there and finding the right person and doing it at the right time. There was restaurant delivery. Different things that happen way too early. Webvan, that was way too early. But then there were delivery services that work because we had the infrastructure and such. But today, what would be the one thing? I think this combination of data and bio is really powerful.
Interesting. Love it. And then that brings me to my next question, the final one. My next guest will be Brad Feld from Foundry.
Okay.
Techstars and all that. What would be your $1 billion question to him?
Brad, I know Brad. Okay. This isn't really an investing question, but I think it's an interesting question because Brad knows how to do his investing and also take care of himself and mental health, right? That's an important thing to him. What was a time where he had the time to kind of sit and linger somewhere, and what happened that was very unexpected, whether it be a person or an event or something? Did he meet somebody? Did something happen where instead of moving on, which we're all in motion, did he sit?
Well, I'm so tempted. I have to ask you that one question. What was that for you?
Yeah. It's been a recent learning for me that you never know who you're going to meet. So for me, it was my current partner.
Huh?
I was in a guitar shop in London.
What?
Didn't have anything else to do. I just moved to London, and he came in, and we just sat there with the owners of this guitar shop. But I had done that another time, and it was a similar, just like an amazing afternoon, because normally you do your bit, buy your whatever you're buying or look at whatever, and then you move on. But if you just sit sometimes and just let the unexpected happen.
Magic happens.
Yeah, magic happens.
And this was the magic that happened because I showed up and I saw you and I was like, wow.
Yeah, we should do it.
We should do it, and let's take this opportunity in beautiful Finland.
Yes.
Well, Lisa, this was such a pleasure. Thank you so much for your time,
You're
your
welcome.
insights, and we're so excited for your next chapter.
Thank you.
And thanks so much for tuning in this week. You can subscribe wherever you get your podcasts and follow our socials on Sarah Chen Global to get the latest on the show. It would really help me out too if you enjoyed this to rate and review our show on Apple Podcasts and share your favorite episodes with friends. I'm Sarah Chen-Spellings, and you've been listening to $1 Billion Moves.